didn't tell me that she was dressing up for golf. So I would have dressed a little different, but that's all right. I look better.
Yes. Yes, I am very casual today. Very casual.
So there's so much going on. And I know that folks asked for a breakout of the attached or detached. And I know Megan's going to go jump into some of those details. On the back end, I know that we had a ton of content last week. So this week, I kind of tried to scale it back a little bit. There's not a whole lot going on economically. Jackson Hole is going on. But I wanted to focus on first-time homebuyers. I think that there's an opportunity there, and I'm going to talk about that. And I'm going to talk about some of the statistics around them in the back half. But we're going to start with the first half. But here's our quote for today. Don't wait for opportunity, create it. It's a simple quote, but in this market, when there's fear and when there's immobility, people are getting stuck and you're left questioning, how do I take that next step? Or what does that next step even look like? I've heard everything from getting back to the basics to going to high tech, to thinking outside of the box, to just going back to what works. Whatever it is for you, you can't wait. You can't sit here because next year, if we do hit a recession and if home sales do go back up because interest rates do go back down, you want to be the person that they think about. You want to be top of mind, and you can't do that by sitting on the sidelines right now, the second half of this year.
Well, and for first-time homebuyers, this is really one of the absolute best times to get into the market, being August, September, and October. You have more choices available to you in August, September, and October than you do during any other part of the year. And so inventory is in your favor. You need to be in the market right now. Even though rates are a little bit higher than where they were earlier this year and affordability might have diminished what they're able to purchase, they still need to get into something because you can't save your way to wealth. And the best way to build wealth is through home ownership. Right. And so it's really important that you're getting back on those buyers that might have tapped out earlier this year and circle back to them and say, now's a great time. You have options. You can buy with contingencies. You can buy with concessions. You can maintain your right to inspect. And so we've got a more normalized market than what we had earlier this year, where people were giving up their firstborn child. This is a great time to be in the market as a buyer. And so I would highly encourage you to get your buyers back in the market.
I could not agree more. And that's where I was kind of going with this week. I just kept what's on my heart. And there's a little fact that happened in the mortgage purchase applications, which I'm going to show, that tells me that some of them know that it's coming. So I'm really excited for the first time home buyer.
Yes, definitely.
So what's going on in attached?
So we had a question about attached markets yesterday. Typically I tend to focus on detached because it's such a larger portion of our marketplace, but we wanted to talk about the attached metrics, and I'm going to zip through a lot of these slides for you today so that you guys can get a sense of what's happening in attached. Now, this data has aged a little bit. And so when we're looking at some of this information, this is based off of the month of July. And looking at July, we've had more transition that's happened as we've trended into August. So some of these numbers have softened slightly from them, but overall, the attached market is still a more competitive market than the detached market is. And so looking at the attached market dynamics and what's been happening with inventory, our inventory month over month came up by 29.6%. We're sitting at about 1,500 total active units available for sale. New listings decreased by about 13%. Sold listings were down by about 17%. And our overall month supply of inventory is sitting at 1.2. Now that's a little bit tighter than what we're looking at for detached single family, whereas in detached single family, we're looking at about 1.7 months worth of inventory when we look at the monthly numbers. And so this market is a little bit tighter, and there's been some compression on this market as people get priced out of buying something that's a single family home. They're looking at attached properties instead. Right. Also, first-time home buyers coming in to look for this. There's a lot of first-time home buyers that look at attached product. And so we see this product being a little bit more restrictive than what we see for detached single family. We're still far short of where we would typically be for the month of July. Usually in July, we have about 2,000 units for sale. We only had about 1,500 units available for sale, but inventory has the tendency to rise going into August, September, and then it starts to decline October, November, and December. The market actually starts to tighten up as we get into October, November, and December. And oftentimes we see a little blip of extra activity going into the winter months. Pending transactions, we peaked out back here in May where we put about 1,600 units under contract, and it's slid ever since then from June and July, where we're putting fewer units under contract than what we have for our baseline from 2013 through 2021. Month supply of inventory, we're still below 1 month worth of inventory for anything under $400,000, making that a highly competitive market where we could still see multiple offers very likely in that sub $400,000 market. It starts to stretch out as we get into higher priced homes between 4 to 600,000. We had about 1.3 months worth of inventory. 6 to 800,000. We're looking at about 2 months worth of inventory. 800 to 900,000, 800 to a million, about 2 months of inventory. 1 to 1.5 million was out to 3.5 months worth of inventory, which is not a bad number, but it's definitely going to give you more options when you're looking in that market from 1 to 1.5 million. 1.8 months worth of inventory for 1.5 to 2 million, and 2.1 for homes between 2 and 3 million. We had no transactions to record that were above $3 million for the attached market in the month of July. Looking at where we are for terms of balance, we're only sitting at 20.7% of where we would be to offset demand if we had that magical 6-month supply of inventory, which is where we hit balance. Again, balance is different than normal or average. A normal or an average market would have about a 3 to a 3.5 month supply of inventory. So that number would be closer to about 5,000 active listings for sale rather than the 7,600 that we have available for sale right now. But again, we're far from a market in balance. We're not looking for a market correction. Oftentimes I hear people say, well, the condo market tanks first when we go into a recession. And that's not necessarily true. That's what happened last time, but that doesn't mean that it happens every time. And in this market, we're not looking for a market correction because we're still completely undersupplied with properties. Where we're most undersupplied with properties are those real entry-level homes in $200,000 to $400,000. We should have about 3,300 active units for sale, and $400,000 to $600,000. We should have about 2,600 available homes for sale. So we should have a lot more inventory in those markets where you're really feeling that strain, where you're more likely to be in multiple offers at that point. The odds of selling is where I take into account all of the available homes for sale versus those that go under contract and or close, and the likelihood of you closing in that 30-day period. And it dropped by 8.4% going from June to July. And it's now down to about 59.9% or about 60% odds of selling, which takes us back to where we were pre-pandemic. And that puts us right in line with where we were from about 2013 through about 2018. We saw a dip here in about 2019 when interest rates went up for the first time, but it was really hot and heavy earlier this year, where the odds of selling reached up to about 84% odds of selling. So we're right on pace with where we should be for the month of July. Usually in July, we'd be at about 58.6% odds of selling. We're at about 59.9% odds of selling. I would say that the odds of selling really starts to level off with the exception of September. In September, we tend to see a dip in sales that happens as kids head back to school right after Labor Day weekend, and our inventory is at our highest point. Our buyer pool starts to pull back, but usually in September, that drops down to about 55.2% odds of selling, and then it stabilizes through the remainder of the year. It actually goes up ever so slightly as we get into November and December, and that's from people pulling their listings from market, expiring and waiting until the next year. The odds of selling was still over 50% for homes that were up to $600,000, about 50% for homes between $600,000 to $1 million, and about 30 to 40% for homes that were between $1.5 to $3 million. We actually did have one transaction that was at $3 to $4 million, so it had 100% odds of selling. So there was one transaction that occurred in that particular price range.
And I want to see that one.
Yes.
I want to see that.
I'm sure that that's a beautiful home that sold during that month. There were 2,900 total show properties during the month of July. There were about 18,000 total showings that were set. That actually came up month over month by about 2.5%. So we had more showings that were happening on homes in July than we did in June. But the shows per listing was down because inventory was up. And so you should have had about 6.3 showings per property during the month of July for an attached single family home. People are looking at fewer homes when they're making a decision to go under contract than they are in detached single family. In detached single family, it takes about 12 contracts to go under 12 showings to go under contract, whereas in attached single family, it's somewhere between 8 to 10 showings should yield you an offer. So we're actually having people look at fewer homes if they're looking at attached properties before they make a decision to purchase. Days depending, we were sitting about 14 average days on market or 5 median days on market. This number has really stretched out just in the last month or so. So I would add probably about 5 more days to that number. number. As of right now, where it's taking about 10 median days on market, and it was 61.2% of all the homes that closed in the month of July were under contract in the first week. That's higher than what we're seeing for detached single family. Detached single family was about 53% were under contract in 7 days or less.
Do you think some of this is because maybe they're more realistic in the pricing when they go to market?
Yeah, and it tends to be a lower price point when
Okay.
we're looking at attached single family, whereas we don't see homes quite as expensive. And so again, having it be a more affordable option, more people can afford to make that purchase, making the buyer pool a little bit larger
Yeah.
than what we see for detached single family. We're still far below where we would typically be for the month of July for average days on market. Average days on market is usually 21. We were at 14, so they're selling about a week faster than what we've seen on average for the last about 9 years. Median days on market is usually 8. We were at 5, so again, faster than what we would typically expect to see. For broken out by price range, again, we're looking at about 2 weeks on market for all the homes up to about 1.5 million. Once you hit 1.5 million, we're looking closer to about 3 weeks on market. $4 to $5 million was 84, and 5 million or more was about 41 average days on market. Those aren't bad numbers because that buyer pool is so small for attached single family once we get into that over $4 or $5 million market stretch. Again, we still saw faster home sales than what we would typically expect for the month of July. Usually in July, we see about 55.4% of the homes under contract in 7 days or less. We saw 61.2% under contract in 7 days or less, so it was still moving pretty quick. For homes that were under contract in the first 7 days, everything was above 50% with the exception of this $800 to $1 million range. And I would venture to guess that a lot of these homes that are in this $800 to $1 million range are in that Lodo market.
Right.
And Lodo market down in 80202 tends to be a little bit slower, where we have more inventory that's available. We also had the closing out of the Coloradan, we had McGregor Square, so we've had new development coming in there that's been pumping up our inventory that comes in at a similar price point as our resale market. And so a lot of people are trending towards the new construction product over the resale market when they're looking at condos in downtown Denver. Close and sold price ratios. Our average sales price was $474,000. That's down 5.4% from where we were in June. So we had some really big pullback in terms of our average sales price, where people have to go a lot softer on their average sales price. But we're still up year over year by about 8.2% in terms of average sales price growth when we look at that compared to last year. Again, this is how prices tend to ebb and flow as we go through the year. If the bar is above the zero mark, that means that we anticipate prices to go up. If the bar is below the zero mark, that means that we anticipate prices to go down. Historically, in July, we see a 1.1% decrease. This year, we saw a 5.4% decrease. So if you're using comps back from March, April, and May, you need to pull back on your pricing strategy by about 5.4%, probably even closer to 7% now as we get into August. Looking at close to original price ratio and close to list price ratio, we're still at 1% over the last asking price, and that came down by about 2.3% from where we were last month. So this number is faring better than what we're seeing for detached single family. Detached single family was 100.3% of their close to list price ratio. That's still above what we would expect to see for July. Usually in July, we see 100.5% of our close to list price ratio. Now we're looking at 101%. But you can see the phenomenal market that we had earlier this year, where we were looking at 6% over last asking price on average as we were in April and May. Those numbers tend to close down and stabilize as we get down to September, October, November, and December, where it comes down to about 99% of its close to list price ratio for attached single family homes. We were still over 100% for close to list price ratio for homes up to $800,000. Once we hit that $800,000 to $1 million mark, we're looking more at those Lodo properties where there's more negotiating power there. So it dropped down to 98.9% of their close to list price ratio. We had some bidding wars that were happening in this $1.5 to $2 million mark that pushed it up by 0.2% over their last asking price, and 2 to 3 million was 98.6% of their close to last asking price. I've had a lot of questions about, should I price high and trickle down my price? And that's not a great strategy. I'm still a big fan of, if you price it right the first time, it sells faster and for more money. And that's what this graph shows, is the close to original price ratio versus days on market. If you price it right the first time, it goes under contract in the first 7 days, like as 61% of the properties are, and it goes for 2.1% over its original asking price. But in days 8 to 14, you're now down to 98.8%. In days 15 to 21, you're down to 96.3%. And you can see that that number continues to deteriorate the longer longer that you spend on the market. So again, price it right the first time so it sells faster and for more money. Looking at our average P&I payment, it actually came down by 6.6%. This last month, interest rates dropped a little bit, average prices dropped a little bit, increasing affordability. So we saw a lot of buyers get into the market and a nice little pop of activity as we went through July. Looking at multiple offer analysis, it was only 27.7% of them sold for over asking price versus what we were looking at for detached single family, where it was 34% of them sold for over asking price. So it's a little bit less competitive when we're looking at multiple offers here in the attached single family market. Most homes, the majority of them are going under contract for a full price offer up to about $800,000, 800 to $1 million. We saw 57.1% of them sell for over asking price. 1 to 1.5 million, it was 48.1% sold for asking price, and about 30% once we got up into that $1 to $3 million range. Looking at how far over asking price, this number has come way down from where we were earlier this year. Earlier this year, we were looking at 8 to 10% over asking price. Now, if you're in a multiple offer situation, we're now looking at 3 to about 4% over asking price. 1.5 to 2 million, we had a couple that sold for 6.1% over asking price, and 2 to 3 million was about 3.1% over asking price. So again, the amount that you have to go over asking price if you find yourself in a multiple offer situation has come way down. Price reductions, we saw 16.5% of homes reduce their price. That's also lower than what we saw for detached single family. Detached single family, it was about 24% ended up making price reductions. Now it's about 16.5%. Usually we see a rate of price reductions at about 18.7%. So we saw fewer price reductions this year as we headed into July. The rate of price reductions has really gone up through August. So again, this market has softened. We've noted that for both attached and detached residential, I'll go into those numbers in a little bit, but it's about 46% are now reducing their price. The price changes by price range, we saw the most price adjustments in this $800 to $1 million range, where it was 35.7% of them ended up reducing their price. Again, that's looking into that downtown Lodo market for where we're finding the majority of those properties. Average price reductions for closings in July was 4.8%. We also know that that number has come up significantly. Now for attached and detached residential, we're looking at about a 6.5% price reduction. Price reductions were slightly higher than what we would typically anticipate for July. Usually in July, we do about 4.6% price reduction. We were looking at about a 4.8% price reduction this time around. Across the board, all the way up to $1 million, about a 5% price reduction, 4.5 to a 5% price reduction. 1 to 1.5 million was about a 5.3% price reduction, and 2 to 3 million was about a 4.2% price reduction. Distressed transactions, we had 2 bank-owned properties that sold out of the about 1,000 units that closed for attached single family in the month of July. So again, we saw a lot fewer of those properties coming to market. We have seen that notice of elections and demands have gone up. And so it's important to note that those properties, even though they're going into foreclosure, they're not making it back to the bank, and they're not showing up on market as a distressed transaction, because they're able to list their home if they get themselves upside down, and they're able to list their home for sale in a very hot market and get out from underneath that home and walk away with all the equity that they've gained in that market. There was a really long period of time between 2002 through 2008 where we had a builder moratorium where it was impossible to build attached products. And so we've seen this onslaught of new construction that's been coming in. So again, we see a lot more of those properties that are now making their way to market in light of the new construction. And a lot of that new construction is happening along that central corridor of Denver for attached single family.
So we got a couple quick questions, and I know we got to get to the second presentation, but hey, Megan, what month historically do we have the highest number of listings on the market?
So typically September. Usually in September, we have the most number of listings available for sale. And then as we get towards the end of September, we see a lot of expired and withdrawn transactions as people pull their listings from market in favor of waiting until next summer or next spring to list their homes.
And question about, should a definition of a balanced market change from 6 months of inventory given how accessible things are?
No. And so again, balanced market is different than a normal or an average market. A balanced market exists when the rate of inflation matches the rate of appreciation and you're not losing or gaining any money on your home. That's the point at which we reach a balanced market. A normal or an average market is probably 3 to 3.5 months worth of inventory based off of data from Denver. We've always trended more towards a seller's market than what we've seen historically. So balanced is not the same as average or normal. And so I'm going to hammer that into your heads so that everyone understands that, because we are now seeing more negotiating power. And so people think about buyers and sellers like they're sitting on a teeter-totter, whereas earlier this year, sellers really had the advantage and they had all the weight on the teeter-totter. And now we're getting more back to a market where people have the ability to negotiate post going under contract, and they want to use that word balance, but balance is actually a 6-month supply of inventory, and that's the rate of which inflation matches the rate of appreciation, not a normal or an average market.
Right. And then you've got months like this where inflation is up over 8.5%, and you've got interest rates at 6%. I mean, there's a lot of things that go into that, but that is a metric to watch and to be able to analyze by. I think when we get caught up in the specific number versus the comparison of the number is where we lose some of, especially what's happening right now. And Teresa brought up a good question about that. So you chose 2013 to 2021. Are you just looking at the last, 9 years, or are you stopping?
So I started comparing. And so to have a better idea of what this market looks like when I do my annual projections, I look at 2013 through 2021, because we've been under a 3-month supply of inventory during that period of time. And so, usually I use that because that's how long we've been in this extreme seller's market, is since we've had less than a 3-month supply of inventory. If I were to compare this using data from the recession, our numbers would look drastically different. And so I don't like to use those. We had two very contrasting markets from 2006 through 2012, and then 2013 through now, where we've had this extreme seller's market, versus 2008 through 2012 was an extreme buyer's market.
Right.
And so I just look at how long have we been in this extreme seller's market, and can that create predictability for us as we put together projections going forward.
Do you have a drink when you go play golf?
I don't drink when I golf. I don't.
Peter
I'm not a day drinker.
No,
I can't
I'm
do
not
it.
either.
Like, it kills me. And so I
And then you're in bed by-
day drink, because you have a hangover by like 7 o'clock at night, and you just feel miserable. And
You
so
do.
I don't drink, and I'll have a drink if I have like a 4:30 tea time.
Yes.
And so I'll have a drink that's like a happy hour time, because I don't really care as much at that point. But when I'm golfing in the morning or the afternoon, I don't drink.
I never drink in the day anymore. I used to, my kids, you can't drink all day if you don't start in the morning. Well, that is a young person sport.
Oh,
all right,
gosh.
so let's go over to share screen for the next presentation, because I know we want to get.
Yeah, I've only got about 8 minutes to go through this, so we're going to go through it super fast. And
Sorry.
so,
this back.
no, you're good.
Okay.
And so looking at where we are for the month, for the week of August 17th through August 23rd, and I'll probably just go through the first 5 slides with you, but here's our heat map, and you can see that the cooling trend continues to settle in. As our cells become more blue, as I track the inflow and the outflow of business, our market is becoming less competitive. We've actually had a slight pop of activity that has happened just in the last couple of weeks when interest rates dropped. That stimulated some buyer demand out there. This last week, as kids went back to school in a lot of different school districts, things started to slow down. Going back to school is a really distracting time. And so rather than going out and looking at homes, we're dealing with tired children coming back home from school and trying to adjust to our normal cycles again. And so oftentimes we end up seeing a lag that happens as kids start to head back to school. Looking at our average daily active count, we were up to 6,600 available units for sale, and that was down week over week by just about 0.2%. So not much of a drop, but it started to stabilize out. Under contracts, pending transactions fell by about 3.4%, with about 1,100 units going under contract last week. Our month supply of inventory is now up to 1.4 months worth of inventory. And the last time we saw that was when we were headed into quarantine back in March of 2020. And so this is the largest amount of month supply of inventory that we've had in about 2 years. That number is roughly stabilized around 1.2 to 1.4 months worth of inventory. It's likely to continue to go up for the next month or so. And then when people start to purge their listings from market going into October, November, and December, that number might come down again. But right now, if you're looking at a market, if you have a buyer in the market, they have about 1.4 homes to choose from. The odds of selling ended up stabilizing again. It only came down by 1.1%, but we're sitting at about a 53.4% odds of selling for this week. So that means that in the next 30 days, based off of this current week's activity, that you have about a 53% odds of selling in the first month that you've listed your property. Looking at where we are in terms of balance, so we only have 22.9% of the inventory required to offset demand. We're still hovering around that about 30,000 50,000 unit mark to have a market in balance where where appreciation matches the rate of inflation at a 6-month supply of inventory. Again, if we were to have a more normal market or an average market, I would say that we would probably need to have about 15 to 18,000 homes available for sale in a more average market here in Metro Denver. Looking at the rate of showings ended up going up this last week by 1.6%. We set 14,207 total showings last week, or about 2.1 shows per property. And so I gave a couple of different presentations in different real estate offices this week. And they were like, these numbers are so nice to hear because we're not the only ones that are dealing with this.
Right.
And I'm fielding probably 4 or 5 phone calls every Monday that say, I put up a new listing and I didn't get any showings the first weekend. What do I do?
Yep.
And the game right now is to wait it out. I'm seeing a lot of people that are going in and making price reductions early, and you want to wait it out because it's taking longer to get people through your house. And I'm seeing more people have a pop of activity the second weekend that they're on the market because they're either waiting out any of those bidding wars that might happen in the first week and waiting until week number 2. And also, again, this is a distracted period where kids head back to school. We'll have another distracting period when we come across Labor Day weekend. And I've been fielding a lot of questions about, do I list over Labor Day weekend or not? And listing over Labor Day weekend, we're expecting showings to drop by about 30 to 40%. And so people that list over Labor Day weekend are more likely to make price reductions. They're more likely to experience longer days on market. They're more likely to have a less competitive market environment. And so if you can list the weekend before or the weekend after, usually the weekend before has more of a pop of activity than the weekend after. Things really start to slide as we get into the back half of September. And so again, we're looking at about 2.1 shows per property per week right now.
So if you have any buyers, you should actively be calling your
You
database.
should be calling them and getting
going
them out
for Labor Day.
Labor Day weekend.
Yep.
Skip that camping trip because you're
Yes.
likely to have some good negotiating power as you go into Labor Day weekend.
Plus, you don't want to be on I-70 or 285 for Labor Day.
No.
Oh,
No.
it's really better. It's just
Sometimes I
better.
forget and go through the
Yes.
town of Morrison to get onto C470 on one of those weekends. And I'm just like, oh, the weekend traffic is
Yes.
killing me. And so we're looking at about 13 showings to go under contract right now. So we saw that number tick up by 1 showing. So again, if you're getting 2 shows per property per week and it's taking 13 showings to go under contract, you need to be prepping your sellers that you could be on the market for as long as 6 weeks, 6.5 weeks, 7 weeks before you go under contract in this market. And so again, it's taking a lot longer to get people through these houses. So again, playing with strike 1, strike 2, strike 3. If you didn't get 2 showings last week, or you've had a total of 13 showings and no offers, maybe time to consider a price reduction. And then median days on market stretched out to 18 this last week. And so now we're looking at about 2.5 weeks on market for half of the listings to go under contract. So that would be strike 3 if you've been on the market for longer than 18 days, then make a price reduction. Week 1 is too early to make a price reduction. So don't leave money on the table by reducing your property too soon, even if you've had no showings.
Especially since it seems like buyers are waiting until weekend too. Like
Yes.
they want to get the deal,
Yeah.
but then so do other buyers. So they
Right.
end up having a bid over.
Yes. And so
Yes.
oftentimes you get a bidding war in the second week.
Yeah.
Looking at price reductions this last week, it was 47.9% of all the homes made price reductions with an average price reduction of about 6.5%. So we're watching the size of the price reductions trickle up as we get deeper into the summer and early into the fall months. So again, slow price reductions are getting to be a lot bigger in our marketplace. So if you need to make a price reduction, I don't know that $25,000 is going to do it. It's $50,000 so that you can get yourself down into the next searching bracket so that you can get your home under contract based off of the way that people search different price ranges. And so another way to price your properties is I see a lot of properties that are priced on the 9s instead of the 0s. People don't look up to $749,999. They look up to $800,000. And so if you cut off that price even by $1,
Right.
you're missing out on that entire bracket of people that are looking at the $800,000 mark. And so price on the 0s and price on those numbers, and you're more likely to get more views per property when you price according to the way that people search through the MLS
Because they'll
system.
search either above that or below it. So you're
Yeah.
hitting 2 brackets.
You're hitting
instead
2
of just
brackets.
1.
Right.
Yeah. Because
Yep.
nobody searches up 2.
Right.
Agreed.
And so it's important that you guys price on the 0s rather than price on the 9s because you're going to get a larger bandwidth of people. I've got 1 minute left. I'll go through the up to $500,000 market and then we'll kind of move on from there and we'll let Nicole do her thing. But I'll send out all the slides for you today that have all of the slides that go up to $2 million for you so that you have those weekly numbers. We ended up seeing that pending transactions held relatively consistent for the under $500,000 market. We're up to 0.9 9 months worth of inventory, which is again back to where we were as we went into quarantine back here in 2020. The market's vastly different. People are still able to go out and look at homes, unlike when we went into quarantine where you couldn't even go out and show a property. But the market has slowed pretty substantially from where we were. At one point, we hit 0.1 months worth of inventory, and that was over Super Bowl weekend, which was just
still
insane.
less than 1 month of inventory.
It's still less than 1 month
Like
of
this
inventory.
is perspective. Like it seems like, oh, well, it's just normal because it goes back, but it's still 1 month.
It's still less
If
than
we
1
go
month
further
of
back,
inventory.
it's not even 2019.
The odds of selling week over week didn't change. We were looking at about a 64.3% odds of selling, which is slightly lower than where we were pre-pandemic, where we were looking at about a 70% odds of selling. So homes have slowed down since where we were. It's more likely that we're comparing this to 2019 as the most similar year that we have for this data. Still only 14.9% of the inventory that we require to offset demand, about 3 showings per week. We're looking at about 12 showings to go under contract. So you need to be prepping your sellers for about 4 weeks on market, and median days on market for homes that went under contract last week was about 13. The rate of price reductions was 39.3% made price reductions, with an average price reduction that jumped pretty significantly this last week. It went from a 6% price reduction to about a 6.8% price reduction. So we're seeing larger price reductions that are happening even in the under $500,000 market.
Interesting.
And so the trend for all other price ranges, I'll stop the sharing. I'll stop now so that Nicole can have all of her time. But we're looking at, slowing down as kids head back to school. And especially as we head into Labor Day weekend, the market's going to cool again. And so it's important that you're getting your listings to market as soon as you can to make sure that we're taking advantage of largest pool of potential buyers that you can, because it's going to start to wane through the end of the year.
So Kathleen asked a question. So when we talk about balanced versus average market, would average then be the point to where buyers and sellers are on equal playing field versus balanced?
Well, it depends on what we consider to be an equal playing field.
Yes.
And so, because right now, even at 1.7 months worth of inventory, people are still getting concessions. They're getting homes under contract that are contingent. They're using FHA, they're using VA financing. And so that's kind of a nebulous metric to try and figure out. But I would say that the point at which we hit about a 3-month supply of inventory is what we're going to determine to be like a more normalized market for us.
And it's per market, right? So Denver is going to be different than Oklahoma City or New York City, but it definitely feels like we feel like buyers have more of an advantage, yet there's still less than a month of inventory under that 500. Right. So you have to look at it by the market. Alan is balanced is the same of homes. Balanced is the same of homes appreciating at the rate of inflation. How do these facts relate to this?
Study that the National Association of Realtors did historically. That's where we reach that same point.
How many homes per buyer?
So we have about 1.4 homes per buyer right now.
And yes, we send out, when you send out your email, can you put in what you said about the difference in the market types? You did that last week though, too.
Yes. And so I will put that together for you. I'm going to include some attached information today, as well as the weekly numbers for you, so that you've got some of those numbers to look at. And I'll just kind of go over what we talked about today.
All right, so let's get into what's happening on the economy. Again, that is pretty limited. There wasn't a whole lot. We've got a lot more conversation going on as far as the recessionary market, especially when it comes to housing. And then I want to give you a little tip that we saw inside the mortgage purchase applications and lead that right into first-time homebuyers and what's making up our first-time homebuyers right now, giving you any advantage to marketing to them, to identifying them, and to finding conversations with them. So let's just jump in. I'm going to share my screen. All right, here we go. So the quote, right? Don't wait for the opportunity, create it. This is your time to do what you do best. Identify that niche and really go after it. You want to be memorable during this period of time, during the second half of the year. I mean, I've heard all kinds of people talking about the fact that the second half of the year is going to be slower. It might be more intense. It might be more stressful. All of those things want you just to lead back into fear or in action, where you have to be in the front of that, educating, propping up your buyers and sellers and giving them the alternatives. Right now, rents are going up. We know that next year, if we do see interest rates drop, we're going to see transactions pick up. We're going to see those multiple bids come back. Those are the kind of conversations that we want to be having with them, not necessarily where the headlines are driving it. So you have to create that opportunity. Don't forget, we're actually at 75% full now. Megan and I are going to be doing this on site, which really excited over by Denver Broncos Stadium. So looking forward to Patty joining us. Make sure to RSVP as we are 75% full. All right, let's jump in. What's going on? So Jackson Hole is going on this week, and I'm going to show you what it's kind of doing to our interest rates, but Powell is going to take stage at 8 a.m. Mountain Time on Friday. I will kind of give the highlights to that on our Saturday email, talking about what, if anything, it changed. Everybody's going to be watching it. Everybody's been watching the lead up to it. And really, we're looking for the messaging. Has he done enough? Yes, maybe we did too much too late. But the question is does he think that we've started to control inflation, or does he need to be more aggressive because it's not yet under control? So based on the conversation on whether or not he needs to let employment start to spike up, whether he thinks inflation is under control, those things are going to lead to either more volatility in our interest rates or more stability in the sidewards motion that we've been seeing up until this week. So I've shown you kind of the rates, and I'm going to show you that in a second, but really we're not looking for rates to come drastically down. We're looking them to come back into the sidewards, I guess the upper and lower, if anywhere from 2.85 to 3.1 on the 10-year treasury is where we had been kind of bouncing between. And now we've spiked above that because Jackson Hole is going on. So we're going to be watching for that. Also, right before, I don't know if this is good or bad, right before he comes out and takes the stage and does a speech and then answers questions, we've got the PCE number coming out. So whether or not that continues to spike up or continues to soften will also impact our bonds. But we saw this tremendous uptick. So we had gained kind of a lot of traction because interest rates had fallen down to 5% for a brief period of time. We saw that because we saw the increase in activity on the real estate side. We were talking about it. You guys were talking about it. The buyers knew about it. People were locking in. Those rates are gone again. So all of this week we saw a spike. If he comes out talking about the fact that we have inflation kind of in our sights, we're doing the right things, we can drop from 75 to 50 bips in the next increase, we're just going to see this kind of drop right back down into that 5.5 range because it's speeding up towards 6 because of the uncertainty. So that's what we're going to be watching at. As far as other economic news, we saw the GDP second look. It's a little interesting. There's 3 looks in total for every quarter's GDP. This quarter, what I thought was really interesting is it's the durable goods that's holding it up. So it went from a negative 0.9 to a negative 0.6. So it's actually heading back towards positive or even towards 0. So it's less of a negative and less of a drain on the economy. The economy continues to try to hold on. We saw durable goods was actually flat month over month. And if you take out those that are most volatile and you go for the core, we were actually up 0.5% month over month. So these numbers just kind of show that we headed back towards that neutral position to where the GDP number might be positive. Again, pulling us back out of that recessionary thinking and just kind of putting it off as the economy is certainly trying to hold on. Initial jobless claims dropped another 2,000. This is after they had redone the previous week. They always redo the previous week, and this time that actually was revised down 5,000. So dropping 2,000, and then last week's revising 5,000. I'm hearing it, and I'm guessing you are too, that there are a lot of people laying off right now. Mm-hmm. Are you hearing that in the news? Mm-hmm. I know we're seeing it in the lending environment, but it's going beyond the lending environment at this point. We're seeing it in furniture stores. We're seeing it in consumer stores. We're seeing it in manufacturing. We're seeing people laying off because there's uncertainty, there's less revenue, and there's certainly less profitability. So as those people are being laid off, they're finding other jobs quickly. Remember, we still have 10.7 million job openings. This will turn though. This will start to go up. We will start to see unemployment going up. And that's the point at which the Fed is going to have to turn their vision towards unemployment as well as inflation. Right now, they're just doubling down on inflation because unemployment is staying low. And in fact, it's giving them a little bit more strength to do what they need to control inflation because unemployment is staying so low. Pending home sales came out this week, down 1%. month over month, down 20% year over year. So all of this continuing to feed into the conversation about this housing recession that's happening. A lot of it, though, is the fact that we're just not seeing the new listings. We see that at the local level, and we're seeing that now at the national level. You have to think about the people that are homeowners right now are in the best position they've probably ever been in. They have an extremely low interest rate. They have a ton of equity. And if they're renting any place in their house, whether it's a room, a basement, an ADU, or maybe that property is a rental, they're getting a ton of rental income. This is just like a win-win-win. There's no reason for a seller to hurry up and sell because 85% of the time they have to turn around and buy again. So right now they're just sitting and waiting, which is causing the new listings to be low, which is going to start to drain on our active listings, which is then going to, of course, the active inventory count, as it goes down, as it always does towards the end of the year, that's going to just be multiplied, which is going to give those spring sellers much less inventory to choose from. And if we enter into a recession and we see rates drop, we could see kind of all things collide at the same time, right?
Yeah, I'm expecting next spring to be busy again. I don't think it's going to be the insanity that we had this year, but it's still going to be competitive as we get into the spring, as it has been for every year going back to 2013.
Which again is just, it's the reason to celebrate the first time home buyers, to get out, to educate, and to communicate. And we're seeing it nationwide. Megan was showing that, but interestingly enough, nationwide, there were no new listings, or at least they zeroed out. So week over week, we absolutely had no active inventory increase countrywide. And when you start to look at that, because I think about the migration too, right? It's not like you're going to get a better deal somewhere. You're going to pay less because it's a less expensive metro, but you're not getting deals right now other than people coming off the highs of wanting to sell for what their neighbor sold 3 months ago. So that readjustment. So Lawrence Yun had come out saying that the terms, in terms of the current housing cycle, we may be close to or at the bottom of the contract signings. He's starting to think that we're going to see the continued job strength, that we're going to see the rate of appreciation slow down from double digits back down to 5%, and that we're going to see more contracts next year, which is kind of what we're thinking as well.
People need an adjustment period as interest rates go up. They're going to adjust, and then they're going to make the move. People are always buying and selling real estate.
And I wouldn't even mind it terribly if we stayed in the fives all next year. If we had the ability to get more inventory so that we could get back towards a normal level, it wouldn't be an awful thing.
No, it's not a bad thing.
It wouldn't be an awful thing. All right. So the other thing that came out is the new home sales. So that came out at 511,000 new signed contracts. So signed contracts on new builds, down almost 30% year over year. So interestingly, though, as I look at this, one of the things that you're also going to hear in the same report is the months of inventory. So the months of inventory was up at almost 11. So it's 10.9 months of inventory. The majority of it is under construction. 7.84 months of that inventory is under construction, and 2.5 of that hasn't even been started. And this isn't even really inventory. Most of this has been sold or is contracted unless those contracts fall out, right? So it's not even bringing a ton of inventory to the new market, but we are going to see housing completions pick up, but we're seeing permits and starts slow down as builders are waiting to see what's happening. We are going to see housing completions. Don't think of that as a celebration time unless those buyers back out of their contracts and open it up for inventory for other buyers to jump into. But we will see that as all of these new builds work their way through the system. So this is kind of where all of this conversation is happening. Like I could pick out 20 or 30 headlines easily from the last 48 hours, but new home sales plummet as a housing recession gains steam. House prices fall for the first time in 3 years. 183, of which Denver is one of them, housing markets could see home prices fall as much as 20%. Right? This is
no.
And then we're on recession watch as the housing market collapses. These are the headlines that your clients are reading.
Oh, I just got goosebumps. No.
We have to continue to educate, which is one of the why I don't know if you saw it. I went on a diatribe. I wrote a very I couldn't help myself. I went on a very long, detailed explanation as to here are the bullet points of the things that I see that yes are recessionary, but then here's all the things and the yellow star bullet points on why the housing market is so strong is double the length of the recessionary. And I could have even gone on longer, but at some point you just got to stop. So I put this out on social. We send it out on our Saturday blog. this has been shared numerous times, almost I think over 30 times. People are sharing it, maybe over 40 times. Share this kind of stuff, use it or take it, like take bits of it, create blogs for yourself, create social posts for yourself, create education opportunities for yourself, whether you're doing videos, whether you're teaching classes, whether you're getting in front of apartment dwellers and renters. These are the kind of facts that we need to continue to put out there, not the fact that we're going to have a 20% price reduction. It's just not
We
possible.
didn't even have a 20% price reduction in the Great Recession.
No, in the worst of all.
No, we've never, that didn't happen.
No,
that didn't happen. I was reading an article where there was it was something that Channel 7 News put out, but there was an agent that had said that home prices have fallen 20% since back in April and May. And it was like, no, we're off 5 to 7%, guys. We're off by 5 to 7%. And that's not too far off from where we would typically be in a normal seasonal correction that we go through every year. It just happened earlier this year. We had a significant run up in the first half of the year, and then it pulled back earlier this year. And that was again due to rising interest rates stimulating demand early this year.
Right.
And so this isn't abnormal.
No, I think as a country, I think the entire country lost somewhere right around 25%. If you look at the HPI index, Denver, we were closer to 11.
Yeah, we lost 10. 10 is what I saw in our worst year. We lost 10% of our home values.
Yes, not 20.
No.
So this is perspective. So we have to continue to drum this in and have these conversations on a daily basis, educating us, having those bullets kind of in our pocket. It's so funny because right now my whole team is going through a communication workshop with Ryan Avery. If you guys have not seen Ryan Avery, he was one of our speakers at the Next Big Thing in February, but he's going through this whole conversation or this communication. And it's having those things in your pocket. He talks about this all the time. What are those facts that you know that you can just pull out in a conversation to derail this negativity, right? To get it back to a place where there's opportunities, because those people who are sitting on the sidelines waiting for the 20% bust are going to lose the opportunity of the greatest opportunity to build wealth, right? Real estate. So back to Lawrence June, because he was talking a lot this week. He was saying that it's not a recession in home prices as inventory remains tight. Prices continue to rise nationally, with nearly 40% of homes still commanding the full price list. We're seeing that here as well as we're seeing it nationally. Yet the market is still moving towards a buyer's favor, right? So it doesn't have to be a buyer's market to have favor after the last 2 years. The last 2 years were intense and ridiculous. So here's the little niche that happened. So in the mortgage purchase application data, it was down 1% week over week. It was down 20% year over year. Doesn't sound fantastic. Demand is down because interest rates are up. FHA applications were up 4% week over week, and the average purchase loan amount size, right? So not for refinances, but for purchase applications, and loan amount size continues to trend lower, meaning those entry-level homes, those entry-level buyers, those first-time home buyers are starting to come back, right? Hopefully you are the reason, right? That they're real estate agents, they're educators, they're hearing the fact that this might be the market that I can get my deal done, that I can actually get an FHA deal, a VA deal, a USDA deal, a down payment assistance deal. So here's some statistics for first-time home buyers that you can grab and capitalize based on who your market is. So in 2021, 34% of home buyers were first-time home buyers, which was an increase over 2020. Now, our last month, July of 2022, per the National Association of Realtors, saw that it was 29. So it is dipping down, which isn't surprising considering the uptick in interest rates. But we'll continue to watch this to see where it trends over the next 3 months. The typical age of a first-time home buyer is 33. We talk about that all the time. That's a report that was put out by Freddie Mac. 65% of first-time home buyers were driven to primarily own their own home. They just want that thing where they can dig their roots, they can paint the walls, they can design it how they want, furnish it how they want, and they can start to not only build that lifestyle for their family, but wealth for multi-generations. So 29% of first-time home buyers said that saving for the down payment was the hardest part, yet the average down payment was 6 to 7%. They don't know that they don't need 20%. Are we reminding them that they only need 3% for conventional, 3.5% for FHA, 0 for VA and USDA? And if they use down payment assistance, again, it's very little as 1%. Those are the conversations that we need to continue to have because those errors in understanding are still out there. In 2021, 28% of the first-time homebuyers applied for a gift. Millennials have wealthy parents, many of them. Those baby boomers have a lot of wealth. That wealth is being transferred. That is a conversation that you should be having. I understand that you're not quite ready because you haven't saved enough. Do you have family members that want to see your success, that you can pay them back even down the road with equity share? So giving them the opportunity to partake in that. 49% of the younger millennials, 44% of the older millennials report student loan debt hindered their ability to save. I'm going to talk about that in just a second. Of those home buyers, 23 to 41 who made sacrifices to purchase a home, the most common was to cut the luxury items. You remember the report that we just talked about? They're giving up TikTok and alcohol.
Mm-hmm.
Yeah, and maybe you don't need those $800 shoes. Maybe you could put that towards buying your home.
I don't know. An $800 pair of shoes is great.
They're pretty
They're
comfortable.
great. I'm a sucker for a good pair of shoes. I don't know about that.
Shh.
I know.
And then
Maybe a $400. I can live with a $400.
sacrifice.
All right.
Little
Sacrifices.
Of the home buyers ages 23 to 41, the most common reason for mortgage denial was insufficient debt to income ratio and low credit score. Do they know that they can get help with their credit score? Our team has a free credit optimization program that we can put them in. If it's not now, then when? How do we support their purchase? If it's not today, 3 months from now, 6 months from now, a year from now. And debt to income ratio, we were all given a gift. You guys saw it. Biden announced that the student loan relief was going to take place. There's going to be more information. I put in here, it's a very long URL. We're going to be sending out, we'll have the PowerPoints up on our Agent Ignite Facebook group, but check out the fact sheet. So you can save, they're forgiving up to $20,000 if you got the Pell Grant. I got the Pell Grant when I was in school. Now my kids didn't get the Pell Grant, so they have access to $10,000 loan forgiveness if they make under $125,000 annual income. And all three of my kids make under 125,000. So I'm very excited about this, but this is helping those students who probably need to file their own income, or they have a household income of under 125,000, be able to afford more. Because at $20,000, even though they were deferred and you didn't have to make payments, and that was also extended to the end of this year for the final time, although last time was also the final time, it was extended to the end of this year. If I am able to waive $20,000, which has to be applied to your debt to income ratio, even if you're making payments or not, based on the loan program, either 1% or 0.5%, that could up my purchase price or my loan amount by $37,500. That makes a big difference on those attached homes that we were looking at a while ago.
Yep, it sure does.
So this is super helpful. Make sure your people know about this. They might not be watching the news like you are. They might not know that he did this. So letting them know, opening the door to a conversation is all it is. Opening that door to conversation. All right, a couple more statistics. 66% of first-time home buyers are white, 14% Hispanic, 11 Asian American, and 9% Black. I read that statistic and I just thought opportunity, opportunity to educate. 9% of all home buyers are unmarried. 21% of those are younger millennials. People aren't waiting to get married first and then buy a home. They're buying a home first. So who do you know that still is single? Maybe they're not even on your radar, but they're looking at, how do I stop paying these exorbitant rents and get into something where I can build that stability? Even if I don't want to live there more than a year, I'm going to convert it into a rental. 51% of the older millennials have at least one child. 8% of home buyers, 23 to 41, say that getting a mortgage is the toughest part. They need a better lender. They need to be introduced to me. Only,
good plug.
Right?
Good plug.
And then only 11% of home buyers ages 23 to 41 contacted a lender first. Usually they went online and they started looking at homes. And that's kind of a big deal. In fact, CNBC picked up an article that we wrote talking about the fact of, why do you want to talk to a lender first? It's so important to get your feet grounded before you start looking at homes that are 600, 700, 800, if 450 to 550 is your price point. Knowing what that is and budgeting for it and fixing your credit and maybe saving or learning about down payment assistance and taking the education programs. There are so many things that they should be doing before they get in a car and start looking at homes. One of the biggest things is to determine what is their price point. So we put this together, and in fact, I created an Excel spreadsheet that I could send to everybody that you can actually adjust whatever the purchase prices are at the top. as well as the interest rates at the bottom. So if you're meeting a different client and you want to show them a price point range, and you know that there's been volatility in the interest rates, and you want to show them everything from 4.99 to 6, because that's where the interest rates have been fluctuating. I put 4.5 to 6, but maybe you want to narrow that in. If you change this top row or this bottom, these payments will recalculate. So the cool thing is if I'm looking at a budget and I need to spend under $3,800 a month plus escrows, so this is just PI, so you got to think another $500 for escrows. What is my budget? And based on the volatility of interest rates, where does that put me in price point? This is the benefit of talking to a lender first, knowing where their top is so that you can start to negotiate based on the information that you're hearing, that interest rates are dropping or going up, going into this weekend, recalibrating those listings that you're showing them, because you know, because they know. Super important to go out educated, not go looking at all the fancy homes that you love first. Kiplinger put out this report this week, interestingly enough, too. And these numbers, I've seen a little slight variation, but overall, they're in the same buckets. And this is super important, I think, because of the power of real estate. The top 1% in the United States is net worth of $10 million. The top 10% net worth is $854,000. This speaks to home ownership. We know that not enough people are purchasing homes because they're afraid, they don't have enough money for down payment, they have too low of a credit score that needs to be worked on. They're missing the opportunity to get into the top 50 or 10% of Americans because they don't own a home. In fact, there was that Harvard study of 65-year-olds, they were only worth on average $6,500. You can't retire on $6,500. But how do we help more people get into this top age? Because here's the other part of the Kipling report that just came out. What the average net worth of somebody is, or the median, I should say. So based on your age, how are you faring? And how do you help those who you serve climb that ladder and get into the top 50% or top 10%? It's through real estate, because this is the opportunity that we talk about. And a shameless plug, I'm going to do it, because in this market, it has never been more critical to align yourself with a partner like Megan and myself, because Megan's creativity on the title side is going to get you out of the issues that are going to scare out a closing at the last minute. I've had plenty of those happen, sitting at the closing table where title wasn't clean, or a lien was found at the last minute.
Something pops up. You need to have someone that's seasoned and knows how to handle it.
Yes.
Has the good team that they can get a hold of to fix those problems.
It's time in that saddle, right? And so it's working with a lending team that believes in homeownership, that's continuing to talk positive, that's continuing to steer your buyers into an opportunity. If not now, then building out the plan. My team doesn't operate just on transactions. We operate on relationship. We operate on success. We believe in homeownership. We track your leads so you don't have to. If you give us a lead, we're going to keep you informed because we're communicating constantly. We close on time and fast. We get crazy creative, as I know you do too. I think that that's the power of the success. We have incredibly competitive rates right now. I continue to look at what the national average is, and we're consistently below it, which makes me feel so good. And of course, we have all the loan programs. And Megan and I, we know a thing or two because we've seen a thing or two.
Yes,
right?
Lots of experience. It makes a difference.
Of experience. So with that, do we have any? Let's see if we have any questions that we need to answer, because we got a couple minutes. Dawn, for some reason I'm not receiving the slides by email any longer. Can I get them, or a link? Because you have a link in all of your
so I send them out every afternoon at 1 o'clock. If you've unsubscribed to my newsletter, send me an email, because once you unsubscribe, I can't add you back in. I have to go through the back end to get you added back in. So send me an email if you've fallen off my list. It's maller, ALLER at firstam.com. Send me an email and I'll go through the back end and I'll get you added back on. But once you fall off and unsubscribe, I can't add you back in. I have to go to the powers that be.
And then Savannah, hey, Megan and Nicole, when going from pending to back on market, would you say to follow the data trends as if it were day one in the market, or would you adjust it?
I would follow the trends. And so I would still look at 18 showings to yield one offer, 2 showings per week. I would still look at those numbers because it's already spent that time on market. It's not like it's a fresh new listing again.
And Clark talking about hiring freezes. I'm seeing hiring freezes as well, but I'm also seeing layoffs. So in fact, one of my teammates and I, we were talking about a lot of manufacturing, a lot of furniture companies, a lot of companies associated with filling up corporate offices. There's a lot of employees that are refusing to go back to the office. So that's going to start to change. I think we're going to start to see a change in the commercial space. I mean, all of this is rippling, and we're seeing hiring freezes, and I'm starting to hear of layoffs. Any additional info to leverage for buyers looking at new construction? So we have, we still do the new construction matches, although I don't know how much, well, I guess they are, because if new builders have inventory and they're trying to unload it and they have buyers that have backed out, they're probably back to giving those concessions. And in fact, we do a lot of those concessions with them. But as far as more leverage for buyers looking at new construction, you're going to have to let me know kind of what you're looking at, because we can definitely get you set up. Do you have anything on that? Okay. And then Allison, send it. So we will be sending out our emails here in just a little bit. I'll send out my email with a link back to our Agent Ignite Facebook group page, where we load up the slide deck as well as a copy of this video from Megan. This is on Facebook Live as well. And then Megan sends out her notes on the high points as well as a copy of her slides. So really the information is in your hands to support your buyers and your sellers to create that opportunity for a smooth transaction. Because right now, the noise and the headlines are creating fear. Our job is to create the path and that light. So I am just looking forward to continuing to support you. Megan and I want to continue to see you and your clients at the closing table as we head into the weekend.
Yes, and I'll go ahead and I'll make sure that we get the links all set up for next month's webinars. We're going to continue Thursdays at 10. We've got a much larger group of people that join us on Thursdays at 10 than we do on Fridays. So we're going to keep it on Thursdays at 10 o'clock in the morning. We do have one, we're going to miss 1 week. Nicole's out of town, so we're going to miss 1 week and take that off. We'll still send out the weekly update so that you guys have that information, but we'll be skipping 1 week in September for you guys.
It's 5 weeks. So they're still going to get 4 weeks.
I know you get a lot. You're still going to get a lot.
Absolutely. Well, hoping you guys have a fabulous weekend. It's absolutely gorgeous outside. Make sure to think of us if we can support you in any way. And until next week, we hope you have a great one.
See you later, guys.
Bye.